Hello everyone and welcome to the Specialty Crops Risk Management webinar series. Today's webinar is the 9th of our 10 webinar series and we're happy to have you all joining us. This series is funded by the North Central Extension Risk Management Center. I'm Olivia Hanlon, Education Extension Specialist for Iowa State University Extension and Outreach. I work in the Farm, Food, and Enterprise Development Program, which works largely with specialty producers on a wide variety of education and outreach topics. Joining us today is Dr. Craig Chase. Dr. Chase started his career in farm management in the 1980s, looking for ways to help producers become more profitable. He began working with farmers wanting to transition from conventional to organic production in the late 1990s, and with small-sized farms on horticultural crop and small niche livestock in the early 2000s. Overall, Craig has over 35 years experience in helping producers of all kinds determine ways to start a farming operation and or improve profitability to an existing business. If you have any questions for Craig today, please feel free to drop those in the chat box as we're moving along, and we will make sure to get those all answered at the end. And with that, I will hand it off to you, Craig.
Great, thank you very much. It's good to be here this afternoon. Today we're just going to talk about, from a risk management standpoint, we're going to talk about financial risk. We're going to talk for probably somewhere right around 30 minutes, give or take. And then, as Olivia had pointed out, then we'll have plenty of time for questions at the end. As we get started, as an economist, we have to make some assumptions. Let's assume that you have developed an income statement from your Schedule F. In other words, Schedule F would be for those people that are sole proprietors and doing farming already. And also, I'm going to assume that you understand some of the basics regarding whole farm and enterprise budgets and what they tell you. We are going to talk quite a bit about it and use those tools, but we're going to have to start off with some ideas of that there's some basic knowledge there at the beginning. Third assumption is you want to evaluate your farm's profitability. So then the question becomes, now what? Now what do I do? So as we look at an income statement, again, we're going to go ahead and determine this and develop this from your Schedule F. You have sale of products, you have a variety of expenses. You'll notice that labor has an asterisk behind it, and I'll explain that in a little bit. So you end up with total operating expenses in this case, sale of products $124,000, total operating expenses are a little over $102,000, depreciation, interest, and net income of $12,400. One of the tools that I really like to use with either beginning farmers or even established farmers is what I call the bucket distribution. The bucket distribution basically looks at all the dollars you receive from the products you sell. In other words, your gross revenue, your gross sales in the case that we looked at just previously was the top line in the income statement. As you receive those dollars, you can then put those dollars into one of four buckets. You have operating expenses, which is the production, marketing, other direct expenses. You have interest expense, which basically is the expense of financing, the financing tools and the financing things that you end up doing to make your business an ongoing venture. You have depreciation expenses, which are basically the capital expenses or the assets of which then you've procured. And then the last thing is the net income. And the net income, of course, is for family living and those types of items. So let's go back to the income statement that we just started with just a second ago, and you have sale of products of $124,000, and we're going to say, okay, that's 100%. In other words, that's 100% of the income that you brought in or the revenues that you brought in. Now let's divide that up. Again, we look at the itemization of the car, truck, and so forth. Now the labor is going to be a little bit of an adjustment from your Schedule F, because in a Schedule F for tax purposes, you cannot deduct your own labor that you provide or contribute to your business. What I'm going to assume is that we're doing that. In other words, we really want to look at what the profitability is of our farm, and to do that, we have to charge for our own labor that we contribute. So you do that, you put a value on that. Your value that you put on is $24,200. Total operating expenses of a little over $102,000, which is 82.4% of the revenue that you receive. In other words, that's going to be a major chunk of where your dollars go once you receive those through sales of products. Depreciation, 4.8%, interest expense, 2.7%, and net income of 10%. So what do these numbers really mean? Well, what they mean is for every dollar of sales, approximately 82 cents is spent on operating expenses. 5 cents is spent on depreciation expense. 3 cents is spent on interest expense. And approximately 10 cents is kept by the farm to pay for family living, growth of the business, savings, retirement, those types of things. What I like to do is I really like to go ahead and I like to take that 10 cents and really put it into a percentage. Because then what it is, it refers to and indicates what your profit margin is. And if there's one thing I think that helps beginning as well as established farmers to better understand their financials is to really understand the concept of profit margin. So in this case, the 10 cents can be converted very easily over to 10%. So why is that important? Well, as we look at margins versus sales, let's again assume that you have a goal. Your goal is that you want your net income, the fourth bucket, to be $40,000. And you're going to use that $40,000 to cover living expenses, retirements, and those other things that it has to cover. And your margin is 10 cents per dollar of sales, or 10%. How much product would you need to sell in order to reach your $40,000 goal? Think about that for a couple of seconds. The answer would be $400,000. In other words, you take the $40,000, which is our income goal, divided by the 10% margin, which means that we have to accumulate $400,000 of sales to be able to get that. Now, let's just say that your margin is 20 cents for every dollar, or 20%. And you still want to have your $40,000 to cover living expenses, retirements, and those types of things. In this case, how much product would you have to sell? $200,000, which is the 40,000 divided by the 20% or the 0.2. So as you see, margins are hugely impact or can hugely impact the amount of sales that your farm is required to make. 10% margin with a $40,000 income goal, $400,000 in sales. Increase your margin to 20 cents or 20%, your sale requirement now is cut in half to achieve the same amount of net income goal. The other thing margin really does is helps you determine, particularly for beginning farmers, to kind of put in a reality check. And what it does is it will really determine and help you calculate what is the size of the business that you need or the scale of the business that you would require. We have to make a couple assumptions here. Assume that your margin is 10%. Your income goal is $40,000. You really have the potential in your farm to have $400,000 worth of sales. If your total farm sales you project, no, really it's closer to 100,000, and I still want to keep my $40,000 income goal, is a 40% margin realistic? Remember the four buckets. The 40% would be the bottom so that the other three buckets could not be more than 60%. Is that realistic? Margins also could be calculated at the enterprise level, and it is at this level where we can increase profitability. So we're going to talk about enterprise budgets here in just a moment. If we want to make pricing, product mix, or production change decisions, we really need to develop enterprise budgets. They're really hard to go ahead and determine, looking at an income statement or Schedule F, where exactly should we make our changes. Once we get our data down to an enterprise level, then it's much, much easier to make those kind of decisions, as we will see in a minute. What is an enterprise budget? An enterprise budget is an estimate of costs and returns to produce a product. Now, I realize that some producers out there, particularly those that are in vegetable production, may have an enormous amount of enterprises or crops. Some CSAs, community supported agriculture farms, have 30 to 35 different crops. I'm not asking you to go ahead and determine budgets for all those, because that would be an extraordinary amount of effort. What I would like you to do, though, is think about what are those enterprises There's probably 4 to 5 of them that really contribute the most to your business. What is it that makes your business unique in the eyes of your consumers? What is it that makes them want to go and purchase your products versus somebody else's? So kind of think of the 80-20 rule. For most businesses, 80% of their profits are provided by 20% of their products. So what are those few handful of products, crops, in the case of a fruit and vegetable grower, that would really contribute the most to your net income? It's kind of an example that I typically show on scale because it's really going to point out how important knowing those margins are to be able to determine whether, again, you have a reality check and determine whether the scale of the business is going to be able to be attained by the resources that you have available to you. So let's just assume that you want to raise pasture poultry and run a small CSA. And again, I'm just going to use the $40,000 income goal. Whatever goal you determine what makes the most sense for you. Definitely use that number instead of the 40,000. It's just one that I came up with. Let's assume that your calculated profit margins are $2 per bird sold and $7,000 per acre. But you're going to max out your labor at 2 acres or roughly $14,000. Questions: how much profit do you need to make from your poultry enterprise, and how many chickens would you then have to sell to get that kind of profit from that enterprise? Well, in this case, you would need 26,000 from the poultry enterprise because you received 14,000 from the CSA, which is basically 40,000 minus the 14. To achieve that 26,000, remember you have $2 margin per chicken, so you'd have to raise 13,000 chickens to reach those poultry sales. So the question then becomes, do you have the capacity to produce 13,000 chickens? If not, then either you're going to have to change your income goal, or you're going to have to change some kind of scale in some of your production units. In this case, either your CSA would have to get larger, or your margins would have to increase. So let's look at some simplified enterprise budgets. And I say simplified because typically they're going to be a lot longer. So in other words, your crop inputs would list out individually what your seed is, what your fertilizer is, those types of things. But in this case, let's assume that one of the crops that you're growing is green beans, and you're doing this in a 4x100 foot bed. Revenue, 120 pounds at $3. You have your crop inputs, you have your labor, supplies, ownership, total production costs, marketing costs because you have to market it, and then you have a profit margin, which again is looking at what's left over after you go ahead and take out all your expenses, both production and marketing, into account. So in this case, again, profit margin is $72 or 20% of the 360. Let's look at another one really quick. So let's just say salad greens. And again, let's assume that they're 4x100 foot bed. The 4x100 foot is really not the important thing. The important thing is that when you compare budgets between two different crops, they have the same space or the same unit of measure. So if you had 3 foot by 50 foot beds, just make sure that they're both on the same size. If you do it on a per acre, do it on a square foot, I mean a high tunnel, whatever it is that you're looking at, just make sure that those units of measure, those land units, are the same. Salad greens, revenue 30 pounds at $5. Crop inputs, labor, supplies, ownership, total production costs, marketing costs, profit margin $53 or 35%. Again, let me just point out real quick that labor is not just hired labor. That would be the labor that you would contribute as well. And the idea being that if you're going to have to pay for your labor, you're going to have to pay for your own machinery, land, any irrigation equipment, anything that you own, any asset that you have, any resource that you use to receive revenue from, you actually should get a return on that. Nothing should be contributed for free. So as we go through this, profit margin $53, 35%. Okay, let's say that your goal was to have a profit margin of 25%, or 25 cents out of every dollar of sales to stay in your business. Again, the idea behind profit margin is that is what is left over to pay for your family living expenses, savings, retirement, and farm growth. So a while back, we talked about picking out those crops that matter, that really contribute to your farm. So let's assume that you found 6 crops. And you said, these are the 6 major crops that contribute the most to my farm. So what's going to follow here in a second is a table that's going to list out those 6 major crops that you believe contribute 80% or more of your whole farm profit. So here we have the 6 crops: carrots, specialty green beans, greens, heirloom tomatoes, potatoes, and snow peas. And you can see the revenue for each one of them, total cost, which would be the production as well as the marketing cost, profit margin, and then the profit margin percentage. So you can see the profit margin percentage ranges from 13% from snow peas to 37% for heirloom tomatoes. And this is why we really go ahead and look at particularly produce on an enterprise budget basis, because the profit margins are not the same for each of the crops. Some cases, they're significantly different. So if I was going to treat all of them the same and try to make changes, I actually may make the wrong changes when I price, when I decide what to grow more of or less of, or if I decide that I need to make some production changes. So it's really important to get this kind of detail. As we looked at the 6, 3 of the crops have profit margin below the goal of 25%, potatoes, snow peas, and especially green beans. So the question then you have to ask yourself is, what do I want to do? What do I want to do to increase the profit margin on these products? The other 3 of the crops have a profit margin above the 25%, greens, carrots, and heirloom tomatoes. So the question then becomes, what do you want to do with those? Are you happy with the numbers? Do you feel that you don't have enough time to devote to all 6 of them to make changes, so you just want to go ahead and work on the 3 that are sub 25%? The choices are yours on what you do with the information once you get it. But it'll at least allow you the opportunity to say, oh, okay, if 25% is my goal and I do have products that are under 25%, maybe I should just go ahead and focus some of my attention on what it is I can do to go ahead and increase those margins. Two ways to improve profitability. One is to increase your profit margin per unit produced. And that's kind of what we've been focused on today. We're saying, what is the profit margin? In this case, our goal is 25%, which is 25 cents out of every dollar of revenue I want to keep for my farm as net income. Okay. The other way that you can raise profitability or improve profitability is to keep the profit margin per unit the same and just simply increase your number of units that are sold. That is a little bit more out of the focus of today's class, but it is a way that you can improve profitability. Again, what we're going to focus on is the first one. We're going to try and increase that per unit profit margin. We're going to say, okay, it's 20% or it's 15%. Is there a way that we can get it up to 25? So in this case, you can either reduce your costs to produce and market that product, or you can increase your price. So let's look at reducing costs first. Okay, let's go back to our enterprise budgets, because we calculated those enterprise budgets. And you can use those to determine both break-even prices and yields. So if we go back to our bean enterprise budget, we can see that the cost per pound of bean was $2.40 per pound. as we compare this number, we look at this number, is that 240, is that a reasonable number? Can we find other producers, or can we find published budgets? Can we go ahead and find some kind of benchmark to go ahead and compare that 242? And then once we decide, okay, we found these benchmarks, somebody else is growing it for 215 a pound, where is it that we can go ahead and improve? Why are we at 240 and the benchmark is 215? Or maybe you'll find out that the benchmark is 240 or something very similar to that. And you think, okay, I got the production part down. The second reason is to track key costs. And in the green bean example, if you go back to the enterprise budget, you'll see that $180 or 82% of the total production cost is labor. And most of that labor is in weeding and harvesting. So the question is, can I lower my labor without reducing yields? In other words, can I be more efficient with my labor? In many cases, what you may find is that with green beans, the longer that you are in the season, the more times you go out to harvest, the less amount of the harvest material that you have to sell, simply because the production is winding down. So you may say, well, maybe I don't need to harvest everything. Maybe I don't need to go out after a certain number of times. Or once I get to the point where I'm only picking 1 or 2 beans for every 10 or 15 feet or whatever that number is, you look at that and say, it's really not worth it. It's costing me more in expenses because of my labor than it is for the sale of that product. When you look at the budgets and you see things such as crop inputs, and you look at certain things that are a very, very small percentage, in this case, 10% of total production costs, reducing those costs further, in other words, a 10% reduction in a 10% item is only 1%. So it really doesn't affect total production costs significantly. So don't really spend a lot of time on those small items. In this case, since labor is 82% of the total production and marketing costs, that's where I would focus my attention. Pricing. The second way of increasing profit margin per unit sold is by simply increasing the price of the product. For an individual product, what does it cost to produce and market that product? So for instance, if we look at snow peas cost $3.06 per pound to produce and market. What should the price be if we assume 25% profit margin? Your sale price would need to be $4.08 per pound. So the question then becomes, will your consumers pay $4.08, or will your competition allow that price? If not, what price will they allow, and what is your profit margin at that price? If you can't get to where you want, what do? In other words, let's say, for instance, you're selling in a certain market, there's an enormous amount of competition selling exactly the type of product that you're trying to sell, and 408 is not possible. 350 is all you can do. So what is your margin at $3.50? Is that something that you can live with? If not, what is your choices? Your choices are, okay, I'm no longer going to grow snow peas, or I'm going to grow fewer of them. Hopefully that they are a invitation, something that people get excited about, come to my booth or buy my CSA, and then buy other products as well. To determine pricing is the same process regardless of what you're producing. Let's say, for instance, you're looking at a CSA. In your community supported agriculture share box, you figure out it costs you $240 per share to produce and market. Can you price it at $3.20? We talked about chickens earlier and said that it was $2 to produce and market that per bird. So you'd have to price those at least $2.67 to get 25%. Again, what you'll have to do then once you look at those prices is, are those prices possible? For pricing, costs need to be known. Otherwise, you're basically shooting in the dark. You really need that desired profit margin added to the total cost of producing and marketing the product. and then you compare it to the customer's willingness to pay in the competition. If you start with the customer's willingness to pay and what you believe the competition will allow, very often you're not going to go ahead and with some products to get anywhere near the margin that you need. And simply selling them at those prices, as many products as you can, will not get you to the income goal of what you've tried to say at the beginning, that 40,000 or whatever that income goal is, to be able to go ahead and achieve that. So you really need to go ahead and develop your enterprise budget, figure out where the price is for your various products, figure out what the margins are for your various products, and then determine what your product mix is. In other words, how many snow peas am I going to sell versus carrots versus potatoes versus whatever your other products are, based upon the profit margins for each of those products. Okay. Market outlet, compare the outlets that are available. Don't focus on selling price. In other words, the revenue, focus on profit margins. There are many times that you may get the highest retail price for a product, and it may not achieve the highest profit margin. In other words, the costs are really extraordinarily high, sometimes in marketing. So that's why we say, figure out your production costs, but also figure out your marketing costs. So what do you do if your major products had an operating profit margin over your goal and yet the whole farm operating profit margin was under? In other words, you did your 6. Let's say that you did the 6 things that you believed were the most important products to your farm. You gave a goal of 25%, and all of a sudden, lo and behold, each one of those was about 25% or slightly more. But yet, when you looked at your income statement, like we did in the first couple minutes of the presentation, and the income statement showed a profit margin of 20%. So the question is, where am I losing where am I losing my profit potential? So were you consistent in how you accounted for revenue and expense items between the enterprise budgets you calculated and the whole farm records that you established to come up with your Schedule F and your income statement? And the other question, of course, is, are your non-signature products heavily capital or labor intensive? Are you in the development stage of your business? In other words, are you trying to promote a new marketing outlet and or product that will take time to become profitable? There are many producers that I worked with over the years that would really like to establish a local market for their product. So they will try and push forward and develop let's say, a farmer's market in their particular community. Well, farmers markets, as soon as you open them, don't all of a sudden attract a large number of buyers. It takes time to develop that market. It takes time to get the buyers to come down to buy the kind of scale and the kind of volume that you're going to need for that marketing outlet. So you just have to understand that. So there may be times when you don't get your 25% and you're okay with that. And maybe the development stages would be one of those times. Are you at the right scale of operation regarding all your products? Do you have a lot of machinery expense for a non-profitable enterprise? If yes, could this be accomplished in another manner? And what I'm saying is that the idea is that you have you can get to the types of assets and the types of machinery and the types of things that you need to accomplish the operations within your farm, but you don't necessarily have to own all of them. What we see a lot when people start new enterprises, that they don't have a lot of the machinery units that are necessary to do those. So they may custom hire to have some operations done. They may lease or rent certain things to be able to go ahead and lower those costs. Improving profitability can occur through increasing your profit margin per unit while maintaining sales levels. And that's kind of what we've been talking about today. How is it that we can go ahead and improve those margins? the use of enterprise budgets is really critical to determining profit margins and determining where you can improve. You can make a lot of decisions once enterprise budgets are developed. I don't think over the years I've ever worked with any producer that once the enterprise budgets have been developed, that they didn't make substantial changes in their operation based on those budgets. If you're below your profit margin goal, what can you do to make it better? What are the opportunities for increasing your price? Many farms undervalue the price of their product. Do you have the right customers? Are the people that you're selling your product to, do they value your product? Do they see the benefit of your product? Do they see that the features and again, the benefits are something that they're willing to pay for? If they don't, then are there other customers out there that you could go ahead and try to attract to be able to get the price that you need, the margins that you need to sustain your business? What are the opportunities for change of production practices to increase production levels or reduce expenses or product mix? All right, thank you for the opportunity to speak to you today. And Olivia, if you want to see what kind of questions we have, that'd be great.
Well, thank you for joining us today, Craig. It doesn't look like we have any questions in the chat box yet. If anybody does have any questions, feel free to drop those in there. But I guess I will go ahead with a question here. Craig, you have a lot of publications available on the ISU Extension Store.
Yes.
If you had to choose one for folks who were looking to start their farm finances or really do a deep dive in there, which one would you choose?
Yeah, I would probably start with the one that, excuse me, is probably most general first. And I think it's called Improving Profitability. And I picked that one because I think it gives you the idea, it really explains how is it, kind of what I talked with today, the fact that if you start doing some of these things, developing enterprise budget and so forth, is that you can really change the profitability of your farm. And I think after that, then you can go more into the details of how do you use an enterprise budget, how do you use a partial budget, how do you use some of those other tools. But I think making the point that there are ways of doing this, I think will get people started.
All right, we'll give folks a few more seconds here in case they want to drop any questions in. But thank you again for joining us today, Craig. And we have one webinar left, and that is on risk management in organics next week with Dr. Kathleen Dillett.
Cool. Yeah, and if for some reason one of your viewers comes up with a question later on, my email address is right there on the last slide. Feel free to say, hey, I listened to your webinar, I had this question, and just fire away with that question.
Perfect. Thank you very much, Craig. And I think you are free to go.
All right. Thank you.